global multi-sector means that we can go anywhere. The world is our oyster. So we can look at asset classes from high-quality bonds all the way down to high-yield bonds, emerging markets, and then sovereigns, and then U.S. government bonds, together with mortgages and other preferreds and converts. So we really can traverse all around the globe. Sure, when we look at the macro side, we have to look at what environment we're in. We have to look at the inputs that we use, and then we have to make a decision on how we want to be set up. So let's go over this. Interest rate view, currency view, environment on how is it risk-seeking, risk-averting, and then accordingly, if we make that decision on a 3 to 6 month time frame, then we're going to asset allocate as we see fit. The dynamic sector allocation, the most important part of our process, we break the world into 3 distinct buckets: U.S. governments and mortgages, a credit bucket, investment grade and high yield, and then a third, foreign, which would include emerging markets, high-quality sovereigns, and then credit. Those can be dollar or non-dollar. Our job on a 3 to 6 month time frame is to asset allocate where we think makes the best sense based on our macro research on a 3 to 6 month time frame. And during that period of time, we also can tweak based on fundamental differences that we see. The world is our oyster. We can look at all facets of fixed income, from investment grade, government bonds, emerging markets, below investment grade, high yield, and emerging market credits, and they can be dollar or non-dollar based. And we look at that from a fundamental basis as we view the world in a relative sense. Yeah, we break the world into 3 distinct buckets: governments and mortgages, a credit bucket, investment grade and high yield U.S., and then our foreign bucket, which would be foreign emerging markets, high quality sovereigns, and then a sprinkling of credits. We have to bear in mind that we're looking on a 3 to 6 month time frame and looking at relative risk of each of these. So let's look at what we have to look at. Yield, quality, stability, not ignoring total return, and then the 4 risks that we look at: interest rate risk, credit risk, currency risk, and then liquidity risk. Over that 3 to 6 month time frame, depending upon the news that we get or information that we get, we will tweak this over that time to the according levels that we think make sense. Yeah, there's 4 steps involved there. Number 1 is idea generation, so it's a push on pull to the analyst. They may bring us ideas or we may push ideas to them. Second step would be a modeling or presentation standpoint, where they would present the credit to us and we'd say yes or no. The third step would be on our income portal, which is internet-based, so any relevant information that we get on a timely basis that's current will be posted on that so that we can see any updates. And then fourth is surveillance, which I think is the most important. That is, when we have more good news or any bad news, how do we deal with that? Well, on the bad news side, we're faster sellers and we live in our position size. On the good news, we want to make sure that if we have good news and it moves, we want to capture either by doing nothing, selling, or basically buying more if we're under our 1.5% threshold. When we look at the diverse sources of alpha, as we put together all the pieces that we discussed earlier, we have 4 sources of alpha. Number 1 is our sector rotation. That predominantly is about 50% of our return. That's number 1. Number 2 is our security selection. How do we fill up the buckets with names, whether it be investment grade, high yield, or emerging market credits? Number 3 would be our currency management. How do we want to view a specific country or currency, and do we want to express that via hedging or unhedging? And then the 4th would be any trading that we do, any yield curve plays, or duration would be 4th. If we had to rank them 1, 2, 3, 4, it would be in the order that I discussed. And I think it's very important to make sure that the asset allocation mix always is our number 1 alpha generator. In addition to our own risk management that we look at, whether it's position size and credit 24/7 on currencies or anything else on liquidity, lack of derivative use, we're also have guidelines internally of management oversight, independent of us, that will look at counterparty risk, duration, volatility, any metric as far as tracking error, and then look at any counterparty approval or counterparty list, derivative use, and that will be independent of us. So we have oversight over us, and I think we cross the T's and dot the I's very well there. The key concerns when we travel are, number 1, I think, is interest rates rising. Number 2 would be liquidity. Now, let's look at it, especially from an institutional standpoint. They've been in a 30-year bull run, which we think the inflection point has changed, and rates are probably going to gravitate higher over the next 2 to 5 years. So if they're in a duration-sensitive product, they want to move. And there's major concern of where do they move to? Is it a multi-sector, low duration, global credit, et cetera, or alternative asset type plan? So that's one concern. Liquidity is how the ability for them to buy and sell bonds at the right prices. And as you make that switch from a high quality to maybe a global lower quality asset, do they have the same liquidity, or do they comfort level with that liquidity? Those are the two main questions I think we get asked. Janet Yellen is probably the most important person to pay attention to. We have to listen to what she says as far as her vision of what the Fed actually has to do to get us out of a quantise. So I think on every economic number, we have to see how they respond and how they react and what their comments are to that as far as minutia of detail, because I think it's very important. The Fed will dictate the path of interest rates, and that is higher. The question is, how fast does that go? Her job is to convince the markets that she's not going to surprise them if the economic numbers get stronger. If they get weaker, we already know that answer. But I think if that gives a sense of non-surprise, I think the market will react a lot better to a rising rate scenario. That's what I think is the most important. We do feel that rates will gravitate higher, so there's direct ways that we can play that in our portfolio and indirect ways. Well, let's look at the direct ways first. Well, we can take the duration of the portfolio down. That's pretty simple. We can use floating rate loans, floating rate mortgages, interest-only mortgages, fixed to floating pay, and then any inflation-linked securities. We haven't used them, but we can use them. And then we can use the financial future market from the short side, so if rates go up, that would benefit. So all these securities or all these situations here will benefit if rates go up, so we can make money on those. Indirect ways is when we try to find asset classes that are negatively correlated to a high-quality asset class that could get hurt if rates go up, i.e. emerging markets, credit. And then the third piece would be currencies. From time to time, there could be an opportunity in a currency that we can use in a rising rate environment because that economy may be doing pretty well. As we look at the markets today, we still like high yield, and we still like emerging markets. And I think there's some tactical opportunities that we may play in the mortgage space as rates go up. We may play from a credit upgrade, i.e. Ireland, or some other credit stories, from a yield play. But the two areas that look to us, you're getting yield in high yield, and you're getting some diversification away from the U.S. with some growth prospects in emerging markets. I think those two would be the more core, and then those other tactical plays around them. If we do believe that rates will go up and the U.S. should outperform, the dollar should go higher. So when we look at some of our foreign situations, not necessarily do you want to have them unhedged. We may have them hedged with their own currency or maybe with another currency, so we really take the dollar out of the equation. What we don't like is we don't like Canada, we don't like Australia, yen or Swiss. We do like some of the emerging market locations. But right now in this environment where the dollar could go higher, probably against something else. And that could be yen, euro, Swiss, Canada. The people have warmed up to our strategy now, I think, after '08. And it appears that they're using us as a risk-managed satellite away from a sort of core index type product. So we're getting a product that they feel has a risk managed in a sort of a probably 4 to 8% volatility range with a return that's, I think, pretty competitive. So they're using us as a satellite in addition to having a sort of index mandate. And I think that gives them a comfort level that we're not going to go, too far away from the benchmarks.